Nvidia has been a phenomenal stock. There's no debating that. Now here comes the but. With Nvidia, the big move has already happened. So the question investors should be asking right now is, where will the next wave of market-beating returns come from? In this video, I'm going to walk you through 7 stocks that the data says could offer better risk-adjusted returns than Nvidia from here. Not guesses, not hype, but companies scoring at the very top of our quantitative rankings. By the way, I'm Steve Reitmeister. I was the editor-in-chief of Zacks.com for over a decade. I'm currently a partner at WallStreetZen.com. If you're serious about data-driven investing, hit that like button now so I know to make more videos like this in the future. What I'm sharing today isn't stock picking based on hype. It's based on the data and the current trends. To put that in perspective, Nvidia sits at roughly a $4.6 trillion valuation. For it to double from here, it needs to add another $4.6 trillion to the market cap. That's larger than the entire economy of Japan, right? Not going to happen that easily. This is not a question of whether Nvidia is a great company or not. It's clearly great. Rather, is about whether it's still a great investment at this elevated price. Meanwhile, smaller semiconductor companies can multiply much more easily from their more modest valuations, right? The AI infrastructure build-out creates opportunities beyond the obvious leaders, and that's exactly what we're hunting for today. So here's what most investors miss, and this is the key insight that drives everything we're talking about today. Nvidia is only ranked as the 25th best stocks out of 65 in the semiconductor industry, according to our Zen ratings model. That means there are over 20 companies in the same industry with better quantitative scores when you analyze them across 115 different factors, covering everything from growth to value, momentum, financial sentiment, safety, and AI factors. So I took a pretty simple path here. I went to the top of the semiconductor industry stock list and selected the top 7 companies based on these Zen ratings, right? They are all A and B rated according to the AI-driven quant model, and given over 20 years of results, it points to well above average performance potential going forward. These aren't random picks. These are the companies that our data says have the best combination of growth prospects, reasonable valuation, strong momentum, solid financials, and positive smart money sentiment. Let's jump into our first top-rated semiconductor stock in Maxlinear with a symbol of MXL. AI data centers need ultra-fast connectivity between servers, between racks, between facilities. Maxlinear makes the chips that enable that connectivity. Why should you care about connectivity chips? Because you can have the fastest processors and the most memory, but if you can't move the data between systems quickly enough, everything bottlenecks. Data center connectivity is becoming as important as computing power itself. Maxlinear designs high-speed data connectivity chips for broadband, data center, and wireline infrastructure. They're benefiting from all the fiber build-out and 5G infrastructure spending that is taking place now. And here's what makes that particularly interesting right now. Maxlinear offers the highest upside potential of any of the stocks we're covering today, nearly 50% according to the Street High analyst target. The stock is up roughly 40% over the last few months, but in the grand scheme of things, it's still recovering from a significant sell-off when an attempted Silicon Motion acquisition fell apart. The market punished Maxlinear for a deal that didn't happen, but the underlying attractiveness of their business hasn't changed. They've gone through recent cost restructuring that's improving margins, because when a deal falls through, management often goes back to the basics, like cutting costs, focusing on the core business, improving profitability. That's exactly what Maxlinear is doing, and is working out quite well. Now let's dig into the data. Maxlinear has a B Zen rating, which equates to an appealing buy recommendation. Even better is realizing it's in the top 6% of all the stocks reviewed in our model. Drilling down the component grades, it also earns solid Bs for momentum, sentiment, and our AI factors, the ones that point to timely stocks. The momentum B rating is important. It tells us the stock has been recovering from its lows. When you see a turnaround candidate with improving momentum, that's often the point where risk-reward becomes the most attractive. The sentiment rating of B suggests the smart money is seeing value that the broader market is missing. And this comes through from the 2 Wall Street analysts tracking the stock. Both are pounding the table on the ample upside to fair value in the coming year, with a street high target 50% above current levels. When analysts are seeing that much recovery potential in a low-price stock, they're saying that the bad news is already priced in. Okay, But there are some risks to consider here. The failed Silicon Motion merger creates uncertainty. What's the strategic path forward? Will they try another acquisition? Will they be acquired by someone? You get it, on and on and on. And the business model is transitioning. Cable and broadband, which were historically strong for Maxlinear, are maturing. They're pivoting more towards data center connectivity, but that kind of transition takes time. But when it comes down to it, Maxlinear is an appealing turnaround story. The market has possibly overpenalized them for a deal that didn't happen, but the connectivity chips they make are essential for AI infrastructure. For value-oriented investors who can stomach a little bit of volatility, this is a classic bad news is priced in opportunity. Okay. Our B rating says the fundamentals are strong enough to warrant attention, and the roughly 50% upside to the highest analyst target suggests meaningful reward for investors. This is the kind of asymmetric bet where the downside appears limited, but the upside is substantial. Our second stock today is Micron Technology with the symbol of NU. If AI is a skyscraper, Micron makes the foundation. Every AI server, every data center, every edge device needs memory, and lots of it. Micron is the largest US-based memory manufacturer, and they're at the center of the most explosive demand cycle in semiconductor history. Here's why you should be interested. Memory is not optional in AI infrastructure. You can't run large language models. You can't process massive data sets. You can't train AI models without enormous amounts of high bandwidth memory. And Micron is the dominant American player in this critical market. Micron has powerful momentum. It's up over 60% in the last 3 months. There are reasons to believe this is not just speculative momentum, but a confirmation of real fundamental improvement. They're the leader in HBM, high bandwidth memory, which is specifically designed for AI accelerators. This is the critical bottleneck in AI infrastructure right now, and HBM is the solution. Every Nvidia H100 chip, every AMD MI300 chip, and every advanced AI accelerator needs HBM stacked memory. Supply is tight, and Micron has secured major supply agreements with leading AI players. The recent earnings report shows robust guidance pointing to multi-year growth runway. They're not guessing about demand. They already have the orders locked in. They've expanded manufacturing capacity specifically for HBM3 and HBM4, the next generations that will power the AI systems in the years ahead. Now let's move to the confirmation from our data. Micron has an A or strong buy rating overall from our Zen rating system. In fact, it's in the top 1% of stocks analyzed across those 115 different fundamental factors. Rarefied air indeed. Now let's dig into the specifics with our component grades. Financials is the key area of strength with an A rating because they're in the top 3% of all stocks. They may only score a B for growth, yet that masks the top 6% showing for the consistency of growth across earnings, revenue, cash flow, EBITDA, and profit margin expansion. Value is also a B even after the recent run-up in price. That's because their future growth prospects have risen even faster than the share price, making it still undervalued at this time. Momentum also earns a B. The strong price action we've seen is confirming the fundamental thesis. When you see strong growth and financials combined with B-rated momentum, that's technical confirmation of the fundamental strength. Wall Street analysts agree with our Zen ratings, given there are 24 analysts covering Micron. 16 have it as a strong buy, 7 is a buy, and only just 1 hold. That's pretty darn bullish overall coverage. We've also seen multiple recent upgrades from Wall Street, specifically citing the HBM opportunity. Analysts are raising estimates as they better understand the magnitude of this demand cycle. Now let's talk about the risk because memory is notoriously cyclical. We're in a strong upcycle right now, but memory markets have crashed before. When supply catches up to the demand, prices can collapse quickly. That's just the nature of the business. But when it comes down to it, Micron is positioned at a critical choke point in AI infrastructure. The data says they're executing flawlessly, growing rapidly, and still reasonably valued relative to the upside opportunity. These are some of the reasons why I added Micron to my Zen investor portfolio in December. Impressively, it has already gained over 80% since I added the portfolio, but I still rate it as a buy for my customers, given the tremendous earnings momentum at play. To see all 20 of the stocks in my Zen investor portfolio, just scan the QR code on the screen. All right. Our third feature stock out of 7 today is Taiwan Semiconductor with the symbol of TSM. Remember the tales of the famed gold rush. The miners often struggled, but the people selling them all the picks and shovels made absolute fortunes. TSM doesn't compete with Nvidia. They actually manufacture Nvidia's chips. They're the picks and shovels play for the entire semiconductor industry, and specifically the AI revolution. Why should you be interested? Because TSM has the rarest ass in semiconductors, a technological moat that's nearly impossible to replicate. They're years ahead of the competitors in terms of advanced manufacturing, and that gap isn't closing, it's actually still widening. They are the foundry for advanced AI chips. They just don't make chips for NVIDIA. They make them for all the major players, AMD, Apple, Qualcomm, Broadcom, and virtually everyone else building cutting-edge semiconductors. When you hear about 3 nanometer chips or 2 nanometer chips, TSM is the only company manufacturing them at scale. And now they're investing $65 billion in an Arizona fabrication plant, bringing leading-edge manufacturing to the U.S. soil. This is a strategic imperative for the U.S. government and dramatically reduces geopolitical risk over time. Those Arizona fabs will be producing 3 nanometer and eventually the 2 nanometer chips, the most advanced semiconductor manufacturing in all of North America. Here's the beautiful part of TSM's business model. They benefit from whoever is winning in the AI chip race. NVIDIA dominates today, but if AMD takes away market share, well, TSM manufactures for them too. If a new player emerges, they'll need TSM. If Apple builds custom AI chips, TSM manufactures those. It's the rare position of being essential without being exposed to any single customer success. Their dominant position in sub-5 nanometer process technology means nobody else is even close at this point. Now, Intel and Samsung are trying to catch up, but right now, if you want the most advanced chips for AI, data center, and mobile, you're going to TSM. Now, let's look at the data. TSM has a B, or buy recommendation, from the Zen ratings model, given wide-ranging strength across those 115 different fundamental factors. They're a mature company with massive scale, so not some obscure growth stock, right? Gladly, B-rated stocks in our system still have a great amount of appeal, given nearly 20% average annual returns going back to 2003. Now let's look at their specific areas of strength. The momentum rating is A, with strong recent price action confirming the thesis. The sentiment grade is also a B thanks to wide-ranging smart money activity. This includes Wall Street analysts who are increasingly bullish as they recognize TSM's irreplaceable role in the semiconductor ecosystem. Now, how about the risks? Taiwan geopolitical risk is the elephant in the room. The majority of TSM's manufacturing is still in Taiwan. If there's military conflict between China and Taiwan, well, TSM's facilities could be destroyed, seized, or rendered inaccessible. This is a real risk that every TSM investor needs to accept. Their Arizona fabs help, but they're years away from matching Taiwan's capacity. But when you get down to it, TSM is an AI infrastructure play with diversification built in. Whether NVIDIA, AMD, or someone else wins the AI chip wars, TSM manufactures for all of them. Again, this is the clear picks and shovels play of the AI gold rush. Stock number 4 is one of the ones most of you probably never heard of, and that's Chipmos Technologies with a symbol of IMOS. That's part of why I find it so interesting. This is a $1.25 billion Taiwanese company that specializes in testing and packaging for memory and display chips, and they're growing like crazy, right? Why should you care about a small testing and packaging company anyways? Because every advanced semiconductor needs testing and packaging. You can't sell a chip without verifying it works and protecting it in specially designed packaging. And as chips get more complex, particularly high bandwidth memory stacks for AI, testing and packaging becomes much more critical and valuable. Chipmos provides assembly, testing, and packaging services, the essential back-end process that every chip goes through before it ships to customers. Think of it like quality control and final packaging and manufacturing. You can't skip this step. They're positioned to benefit from the HBM demand explosion we talked about with Micron, right? High bandwidth memory, use a 3D stacking where you have multiple memory chips stacked on top of each other. Thus, testing those stacks is incredibly complex. You can't just test each chip individually. You have to test the entire stack, the connections between layers, the thermal characteristics. Chipmos has that expertise in this critical area. Here's what makes Chipmos an interesting investment. low analyst coverage, which creates information inefficiency and opportunity. It's under-researched, undercovered, and therefore potentially mispriced by the market. For example, the recent earnings report showed a forecasted return on equity of 271.99%. Now, that's truly an exceptional number. Remember that ROE measures how efficiently a company generates profit from shareholder equity. Anything over 20% is impressive. When you see over 200%, that tells you the business model is working incredibly well, right? Not surprisingly, Chipmos has an A or strong buy rating overall from our Zen ratings model, given how it's outperforming across multiple fundamental factors. Digging into the component grades, they stand out the most for momentum, sentiment, and the AI factors, all with A ratings. We haven't talked about the AI factor yet. This is based on 20 years of scanning market data to find clues of stocks ready to outperform. And in that vital category, analyst scores in the top 2% of all stocks we reviewed. The A rating for sentiment tells us the smart money is buying in. Our sentiment analysis looks at insider buying, institutional ownership changes, and Wall Street analyst activity. When sentiment gets an A rating, it means the people with the most information about the company are bullish. A good reason for the rest of us to take notice. Recent earnings showed the company is benefiting from increased demand for memory testing, particularly for advanced packaging for HBM and other high-value chips. As for the risk, this is only a $1.2 billion market cap company. More volatility comes with the territory. Being Taiwan-based creates the same geopolitical risk we talked about for TSM. It's a real risk factor you need to accept if you own any Taiwanese companies. But as long as Chipmos keeps growing revenue and maintaining solid profitability, it looks like a real hidden gem, that being a pure play on the back-end services that every advanced chip needs. The combination of an overall strong buy from the Zen ratings and with exceptional momentum and sentiment scores, coupled with the low analyst coverage, creates an under-the-radar opportunity for investors willing to take on a dash more risk. This is the kind of stock that could potentially double or triple when the market finally pays attention to the serious growth that is taking place. Speaking of stocks with extreme upside potential, I've created a free report featuring 3 stocks I believe could double or more in the coming year. Click the link in the description or scan the QR code on the screen to get it right now. We only have 3 stocks left as we move on to number 5, that being Silicon Motion Technology with a symbol of SIMO. AI doesn't just need processing power and memory, it needs storage, massive amounts of it. Silicon Motion designs the controllers that manage SSD storage in enterprise servers. As data centers explode, so does their opportunity. Why should storage controllers interest you? Because they're the invisible intelligence inside every SSD drive. You can't just stack NAND flash chips together and call it a drive. You need sophisticated controllers to manage data writes, error correction, wear leveling, and performance optimization. That Silicon Motion is a leader in this critical technology space. They're also the leader in NAND flash controllers for enterprise SSDs. When Microsoft or Amazon or Google build data centers, those servers need storage, and people want what they offer. Silicon Motion recently increased guidance citing strong data storage demand. This wasn't a modest increase. They meaningfully raised their revenue outlook because orders are strong and visibility for the future is improving, right? Looking into the data, it will surprise no one that Silicon Motion has an A or strong buy recommendation from our Zen ratings model. Sentiment is their strongest component grade, suggesting the smart money remains bullish despite the stock's 125% gain the past year. You might be disappointed by the array of C ratings and other categories, but that is the largest bucket with over 60% of stocks in the C category, meaning it's just kind of a neutral review. As we dig into the specifics, we find that they are actually in the top 30% of all stocks for value, growth, momentum, safety, and financials. So perhaps better to think of that C as more of a C plus or maybe even a B minus, right? No weakness, thanks to widespread fundamental strength, even if just C rated, is a recipe for outperformance in our proven model. Gladly, Wall Street analysts see upside as well. They have 3 strong buy ratings, 2 buy ratings, and no holds and no sells. That's unanimous positive sentiment for the stock. As analysts dig into the ample demand for more data centers, they have forecasted earnings growth of 35 to 40% annually for Silicon Motion over the next 2 years. This strongly supports the bullish outlook for the stock. As for the risks, the NAND flash market is cyclical and competitive. We've seen NAND prices collapse, before when supply exceeds demand. When that happens, controller pricing gets squeezed too. Customer concentration is a factor. Silicon Motion sells primarily to a handful of large SSD manufacturers. But bottom line, Silicon Motion is an under-the-radar way to play the data center build-out thanks to the AI revolution. Plain and simple, enterprise storage demand is exploding, and they're positioned right in the middle of it all with leading technology. For investors looking for AI infrastructure exposure beyond the obvious names, Silicon Motion offers a very appealing investment outlook. All right. Semiconductor stock number 6 of 7 is Semtech Corporation with a symbol of SMTC. Not all AI happens in data centers. Increasingly, AI is moving to the edge like smartphones, car, Internet of Things devices, and industrial equipment. Semtech designs the specialized chips and platforms that enable AI at the edge, and this is a market that's just beginning to explode higher. Why should this interest you? Because while everyone is focused on ChatGPT running in data centers, the real proliferation of AI will happen at the edge. Billions of devices adding intelligence locally, that's the next frontier, and it's potentially even larger than the AI data center play. Semtech is a leader in LoRa, long-range connectivity technology for the Internet of Things. LoRa enables low-power, long-range communication for the Internet of Things devices. When you need to connect sensors, smart meters, agricultural monitors, industrial equipment across large areas, LoRa is often the best solution. The company also recently acquired Sierra Wireless, which expands Semtech into cellular Internet of Things and industrial edge computing. This was a strategic acquisition that gives Semtech a much broader product portfolio and customer base in industrial edge applications. AI-enabled smart infrastructure is becoming a major growth driver. Think smart cities, smart buildings, intelligent supply chains, precision agriculture. All these applications need edge intelligence, connectivity, and lower power consumption, exactly what Semtech provides. The total addressable market is enormous. We're talking about billions of devices that will add intelligence over the next decade. Smart meters, environmental and sensors, asset trackers, industrial monitors, the list is endless. Looking at the Zen rating, Semtech has a B or buy rating, as it is in the top 7% of all the stocks we analyze. The component grades tells a strong story. Momentum, safety, and financials are rated all B as well. That safety B is the most impressive in the top 8% of all stocks we track. That is very rare for a semiconductor growth stock. The momentum B rating, putting them in the top 16% of all stocks, confirms the positive price trend that is already firmly in place. And the impressive financial score, a B, stems from reviewing 26 different measures of financial strength, putting them in the top 9% of all companies we track. Now, Wall Street analysts are also increasingly bullish on the stock. We have 14 analysts covering Semtech with 8 strong buys and 5 buy ratings. That's overwhelmingly positive support. Okay. The company's recent earnings beat raised confidence, leading analysts to revise estimates higher. One of the main reasons why was the successful integration of Sierra Wireless so far. As with any stock, there are risks to consider. For example, the Sierra Wireless integration is not 100% complete. They still need to combine product lines, sales teams, and technologies without disrupting customer relationships and profitability. And yes, the edge AI market is still in its early stages, but what happens if adoption is slower than some of the current projections? But overall, Semtech is an exciting pure play on the next phase of AI bringing intelligence to billions of edge devices. While most companies focus on data center AI, edge AI is the next frontier, and Semtech is positioned to be the leader. This is a stock that could significantly outperform if edge AI adoption meets current projections and be a multi-bagger if adoption proves faster than expected. Now on to our 7th and final top-rated semiconductor stock today, and this is the most direct challenger to Nvidia. We're talking about advanced micro devices with the symbol AMD. Everyone knows Nvidia dominates AI chips, but AMD has something going for it as well. They're in second place in a market growing so fast that second place can still mean tens of billions in revenue. With AMD, their MI300 series of AI accelerators are gaining real traction. Microsoft Azure is already using them. Meta has deployed them at scale. Oracle is building MI300 based infrastructure. These are all key validation points that matter. Data center revenue is growing triple digits year over year. That's the same growth trajectory Nvidia showed in its early stages. AMD is years behind Nvidia in AI adoption, but they're quickly catching up and seeing the benefit. This helps explain the major partnerships they've already locked in. No doubt more are on the way. These aren't just pilot programs, these are multi-year commitments to deploy AMD silicon at scale. And there's something people forget. AMD's CPU business remains a strong cash generator. So beyond AI accelerators, AMD is taking server CPU share from Intel and generating steady cash flow to fund their AI investments. Plus, these shares are significantly cheaper than Nvidia on a valuation basis, and that gap matters when you're hunting for the best risk-adjusted returns. Okay. And here's what makes AMD particularly compelling as our final stock. It offers over 40% upside to the average Wall Street analyst target prices. Even better is some analysts are predicting over 70% gains in the year ahead. That's substantial upside for a strong buy-rated company with impressive fundamentals. Here's something else interesting about AMD. It's actually down over the past few months. Now, normally we don't like stocks going down, but in this case, I think the market has created an opportunity. The fundamentals haven't deteriorated. If anything, they've only improved, but the stock is pulled back, creating an attractive entry point. Looking at AMD through the lens of the Zen ratings, it scores a B or buy rating. All in all, it's in the top 9% of all stocks we analyze based on the strength of its fundamentals. When you have a stock ranked higher than Nvidia, with a lower valuation and recent price weakness creating an entry point, that kind of gets my attention. And should get yours as well. Their top 13% showing for growth is a testament to their appealing growth trajectory across multiple divisions. The data center, AI accelerators, CPUs, gaming, this isn't a one-trick pony. Now, Wall Street analysts are also seeing significant upside potential. There are 25 analysts covering AMD, 15 have a strong buy, 4 have a buy rating. And as already shared, we have appealing fair value targets for the coming year, with many coming in 40 to 70% upside potential in the next 12 months. That's overwhelming positive sentiment for people who follow AMD and Nvidia very closely. The bull case is straightforward. AMD continues taking AI share from Nvidia, continues taking CPU share from Intel, and the market eventually recognizes that more fully in the share price. As for the bear case, well, AMD has nearly 40% smaller R&D budget than Nvidia. In semiconductors, R&D spending matters. If you can't keep pace with the technology leader, the gap seems to widen over time. Intel is also trying to compete in the data center market. Quite frankly, I think Intel is years behind at this point, but they're spending heavily and they could become a real player down the road. But all things considered, AMD offers direct exposure to AI chip demand with a lower valuation than Nvidia. The market is so large that even capturing 20 to 30% market share creates a massive opportunity. For investors who believe in AI growth but think Nvidia is getting overpriced, AMD is the much more logical choice. Our proven quant model says that AMD is in the top 9% of all stocks based upon a complete 115-factor review of its fundamental profile. So scores higher than Nvidia, better valuation than Nvidia, and after the recent pullback looks like a great time to accumulate shares. And with those robust price targets from Wall Street, AMD offers compelling risk-reward as a final core holding in just about any portfolio. So all 7 of these semiconductor stocks have higher ratings than Nvidia. Do you agree? Leave a comment below and let me know if you're a fan of any of these 7 picks, and if not, then why? As the AI revolution continues, there will be multiple winners in the semiconductor space, so it's wise not to just bet on one company to dominate everything. Instead, it's better to broaden out your investments to other logical players in the field positioned to benefit from the massive AI build-out. Is anything I said today a guarantee that I'll outperform? Of course not. Nothing in investing is guaranteed. But the combination of the Zen ratings and bullish coverage from Wall Street analysts dramatically stacks the odds in our favor. And that's what disciplined, methodical investing is all about. I've given you the framework and the data, but every investor needs to make their own decisions based upon their own risk tolerance and time horizon and portfolio objectives. So go ahead and check out these stocks on WallStreetZen.com to see the full Zen ratings breakdown and the Wall Street coverage and the rest of the key fundamental metrics. And lastly, I want to share that I've curated another set of great opportunities the market is missing. Stocks that our data says are poised for significant outperformance in 2026. Check them out now.